Investors are used to thinking of cash as a safe asset. But in the environment you describe, where governments need to print money and finance big deficits in order to stay out of deflationary depression, my question to you, Ray, is should investors continue to think of cash as safe?
I really believe that in this environment, most investors will think safe is cash, and that's tragic. So you can see that one has to think differently from one's habits. When one thinks cash is not a safe investment, it's a risky investment, that stocks and bonds are not the same as they were in the past. One has to think of the storehold of wealth concept rather than just equity returns. One has to think about balancing differently. All of these things that I'm bringing up are not commonly thought about. They're not part of the common experience of investing over the past many years. In order to understand the lessons of history and even what's more likely to take place, one has got to go back to periods that were analogous to this and to study those periods. And when we did that over the last 500 years, you could see that you don't know if you're going to see the depreciation of the value of money and the storehold of wealth. So all of a sudden that changes what you define as risk. You used to think cash as a riskless asset. Cash can be the most risky asset as it depreciates in value. And then you start to think about different asset classes and different locations. So that's what we're doing. When we think of what is the diversified portfolio for an easing that happens at that time, that's kind of a reflation portfolio. And how do you measure that in relationship to other things? Because I think the one thing that we could be confident is that the Federal Reserve and other central banks are not going to let an implosion happen without printing a lot of money.
I want to ask you a